Our speakers today are Picnic CEO Charles Pollock and Chief Actuary of our ARC, Simone Collins. Charlie is a career actuary of more than 30 years and spent 9 years at UWE as Chief Actuary. Prior to that, he was Principal Actuary for Home Insurance at Suncorp, and he's been the CEO at Picnic for 7 years. Hi, Charlie. How are you?
Hi, John. Very well, thank you.
Good. Simone is also a career actuary, former head of corporate actuarial at UWE. She joined Picnic almost 4 years ago. Simone is the vice chair of the annual Catastrophe and Risk Symposium, and she will take us through our ARC Mutual as a discretionary mutual case study today. Welcome, Simone. Thanks for joining us today.
Thanks, John. Good to be here.
Before we get started, a reminder that you'll find a Q&A option at the bottom of your Zoom window, and we encourage you to type out questions as you think of them, and we'll aim to tackle them at the end. Over to you then, Charlie. What does Picnic do?
Thanks, John. Picnic designs, operates and supports discretionary mutual funds as alternate risk structures for associations, brokers and other groups seeking an alternative to the GI market. We specialise in discretionary mutual funds. We have our own AFSL and have operated for over 7 years. And we have 17 people in our team spread across Queensland, New South Wales, Victoria and West Australia. We find innovative ways to create or access products, whether they are risk protection or insurance for those that seek our help. And since 2020, we've launched 6 DMFs that operate in Australia, New Zealand and the UK. And we have more in development, and we've also helped 2 other mutuals get live that we don't manage.
Great. And what exactly is a discretionary mutual?
It is a great question. A discretionary mutual, as we operate them, is a public company limited by guarantee that is collectively owned by its customers. The discretionary mutuals issue a product that is an alternative to insurance called risk protection. As soon as a customer joins the mutual, by paying for their risk protection, they become a member of the mutual. A discretionary mutual has a board of directors, which should include member representatives that presides over every claim. All members own the mutual equally, and this entitles them to 1 vote on matters at the annual general meeting. Mutuals are not-for-profit organisations, meaning that any operating surplus that develops through normal operations remains within the organisation for the benefit of members.
Brilliant. Now, why do they exist and why would anyone join one?
Yeah, discretionary mutuals drive customer-centric innovation. They allow for the creation of specific wordings that reflect the needs of its members rather than accepting general market wordings. For each Picnic design risk protection wording, we prefer to create simple, clear and broad wordings with few exclusions that are clearly articulated. And we also try to develop wordings that truly reflect the needs of the members. As not-for-profit organisations, there is a benefit for members with good risk management and fewer claims, because the surplus after fees and claims are paid is retained by the mutual. So this can be used to reduce renewal prices, fund new products or expand the coverage of the products. Compare that with a for-profit entity. That's the profit that's used to fund, amongst other things, investor dividends, which is essentially lost to the members or to the customers at the end of the policy period. So organisations join DMFs when they want an alternative to the insurance market, and they tend to be aligned with the purpose and intent of the mutual.
Right. And what's the discretionary part of the name there?
Yeah, so discretionary mutuals issue a product that is an alternative to insurance called discretionary risk protection. It's not a contract of insurance under the Insurance Contracts Act or the Insurance Act, and risk protection is a miscellaneous financial risk product. The discretion part refers to decisions of the board of the mutual acting at all times in the interests of members. So discretion can apply in a few areas: claims. So the board has discretion over every claim, and the member, as a protection holder, has the right to ask the board to consider any claim, even if it appears prima facie to fall outside the product wording. Other aspects of the operation of the mutual, such as contributions, membership, and continuation of protection, are also ultimately subject to board discretion at every point.
So we promised to dispel a few myths today. So what are the three biggest myths about discretionary mutuals?
Probably the biggest one is that they're the same as a discretionary trust. So they are two different legal structures. They operate very differently, yet use similar words. A DMF is not for profit financial services organization that issues risk protection as an alternative to insurance. As we've discussed, the organization is owned by its members. Some of those members serve on the board. Some of those customers will serve on the board. The board has discretion over every claim. And when there is a surplus, it's used to offset against renewals or fund new products. Whereas a trust is a legal relationship where a trustee holds something of value for the benefit of others, the beneficiaries. The trustee can be a private company with a sole director. The beneficiaries can be one organization or several. In the insurance industry, the trustee has discretion over which insurance policies to bulk purchase for the beneficiaries. The trustee decides which wordings, at what price, and for what commissions. It does not issue any products. It is not a financial services company. Funds that go into the trust must be exhausted every year. If there's anything left over after purchasing the insurance and paying the claims out of the trust, it must go back to the organizations that provided it.
Right. So that's the biggest one. What's the second biggest myth?
Yeah. For the other biggest myth about discretionary mutuals is that they don't pay claims. Discretionary mutuals issue and exist rather to protect the members from risk events. If they didn't pay claims, why would anyone join one? The directors have a duty to act in the interest of members at all times. So is arbitrarily rejecting a claim for no decent reason in the members' interests? Arguably not. So the board of a discretionary mutual has much greater flexibility about how claims are paid. Whether that's 100 cents in the dollar or less is only one part of it. The board may exercise its discretion to pay a claim that prima facie is outside the protection wording, or pay a claim to an amount that exceeds the limits implied by protection wording, if that is in the interest of members. And because DMF boards also include members, the people considering a claim have a real world experience from the member's perspective and knowledge of how this claim would be affecting the claimant.
Right. And what about the third biggest myth?
Yeah, probably that they are only for uninsurable or bad risks. I mean, low risk members and people with great claim experience, in fact, are the biggest beneficiaries of mutuals because that surplus is retained for their benefit. Especially where the insurance market does not fully recognize their low risk, they may particularly benefit from a mutual. In terms of examples, let's say climate exposed properties where there is pricing uncertainty. If the insurance market pushes up prices in response to the uncertainty of climate change on risk, and the claims experience that emerges is less than projected, the resulting surplus in a mutual will be retained for the future rather than lost to shareholder dividends, which might be the case in a normal insurance situation. So the favorable experience is retained, and that's the key reason why good risks actually are probably the main beneficiaries of a discretionary mutual. And if a mutual only took members that make lots of claims and don't pay sufficient contribution, then that song wouldn't last long, because the capital base would be depleted and the reinsurance would be unobtainable. So no, DMFs are not for bad risks. And uninsurable is an interesting one because what makes something uninsurable in the insurance market is often, going to be uninsurable in all situations. And at Picnic, we don't make assumptions around the risk, and we assess a member for their true risk to determine if there's a way to create a mutual that is going to be viable in the long term. So with the mutuals we operate, like our ARC, we assess every individual property, determine its true risk and price it accordingly, whether that's one building or 10,000 buildings that are owned by a member. Each member of the mutual needs to pay their way, basically, for the mutual to be sustainable. So you can't have unfunded cross subsidies and things like that.
Right. That all makes a lot of sense. So what does all this mean for brokers?
I guess to the extent that the brokers have the appropriate licensing, it gives the brokers an opportunity to explore alternatives for their clients, and particularly alternatives that may be more aligned with those clients' values.
Brilliant. Okay. So that makes a really good segue over to you, Simone. Tell us all about our ARC.
Yeah, sure. Thank you. So we launched our ARC almost 4 years ago, with the foundation member being the Anglican Diocese of North Queensland. They had about $150 million worth of property spread all around North Queensland, including up into the Torres Strait and across into remote Western Queensland. When we launched our ARC with the A&Q, they wanted it to be open to any organisation that was vital to a local community, which is quite a broad definition there, and not just specifically focused on Anglican assets or faith-based assets. So we've grown our ARC over the last 4 years with that in mind. At the end of August, we had over 160 members of various sizes within the mutual, from kind of single property, little pony club, for example, as one of the smallest members, up to members that have thousands of properties spread across all across Australia. So it's over $3.8 billion worth of property within our ARC now. That's across every state and territory in Australia. And our ARC provides buildings, contents, equipment, business interruption or consequential loss, risk protection to its members. So not insurance, but the risk protection products. And we also have available for our ARC members a separate cyclone insurance product, which we issue alongside the risk protection products, which is then reinsured by the ARPC cyclone pool, so that the members can get the benefit of that as well.
Brilliant. I mean, that sounds like a lot of growth in a short period of time. How has that been achieved?
Yeah, it definitely is a lot of growth. We've achieved this by working with the membership base to design products that are specific for their needs, and making sure that we are catering for each of the different communities that our ARC services. So, for example, we've got now 7 product disclosure statements, PDSs, with 7 different products that are tailored to specific communities. This includes community housing, accommodation providers, childcare, aged care and NDIS housing. We've got faith, and we've got education providers. And then we've also got a general PDS, which covers organisations that don't fit into one of those neat categories, so other not-for-profits and associations and those sorts of things. And within those products, as I said, they're tailored to each community, but we do try to make them as broad and as fair as possible. So, for example, flood and bushfire is included as standard within the protections. They don't have a long list of sublimits within the protection, so we do try to make it quite simple for the members to understand exactly what they are protected for. And within that, we also don't apply an excess like a typical insurance company would. Rather, it's a claims hurdle, which is like a franchise deductible. So if a claim exceeds the hurdle, then 100% of it is considered for payment from the ground up, rather than needing to deduct that amount from any claim payments that's made. So the members really appreciate that, in it being able to help them manage their finances for a large loss, rather than them needing to actually wear that cost themselves. And we also allow each of the members to tailor the basis of their protection. So, for example, we've got full replacement or fixed limit ones. So if a member only wants to protect up to a certain limit, we can allow for that within the product. Or in the case where actually they might not want to rebuild a building, which is often the case, for example, with some of the faith assets, where they might have churches in remote areas that they wouldn't rebuild if anything was to happen to that. We can actually protect them on a basis that allows just for a removal of debris and make safe only, and that brings down the price a lot for that protection. So being able to tailor exactly what we're protecting for each of the members and each of the properties within each membership as well. And as Charlie mentioned, we do risk-based pricing. So we help members to understand what properties might be driving pricing. We can look at flood and bushfire, cyclone, hailstorm risks for each property, and help them to single out, this particular property might be highly exposed. So what would you like to do about protecting that one and having that price versus benefit discussion with each of the members. So it's a more collaborative approach, I suppose, in bringing the membership base into our ARC. And that's helped with the growth because the members do appreciate that personalised protection and the personalised service that we're able to offer, and they can make informed decisions about what to do with protecting each of the buildings that they have within their portfolios.
Brilliant. And what about claims? Claims is crucial. How has claims worked?
Yeah, exactly. It's a crucial part of the protection. So since launch, we've had 76 claims of various different types. We've had catastrophe claims, we've had fire claims, we've had accidental damage, quite standard claims. So every single one of those has been discussed by the board. That's not the case with every mutual, but our ARC board is heavily involved with each of the claims because it is a rather small volume and they do have quite involved interest in the membership base. And the board within that discussion looks at the circumstances of each claim and considers what's best for each of the members in the payments of the claims there. So out of that 76, 4 of them have been declined by the board. One of those was because it was termite damage, and that termite damage predated the member joining our ARC, which was proven within some of the reporting that we had around that claim. So that's a pretty standard denial, that if something's happened before taking up protection, then the board won't consider that claim. And the other 3, the members had selected claims, selected hurdles that were higher than the claim amount. So the board made the decision that, you know, say the hurdle was $10,000, the claim amount was $5,000. The board applied the conditions of the protection and decided to decline those claims rather than remediate them. But in any case, the member still has the right to request the board to consider a claim, even if it is below the hurdle.
Yeah, is that what the board does with its discretionary powers, declining claims below the hurdle?
No, there's much more that goes into the discretionary piece around that. So it's really around how to settle each claim as well. And we do have a few examples where the board has applied discretion to settle a claim that might be atypical to what an insurance company would have done in the same situation. So for example, in the 2022 floods, we had a community housing organisation that had houses in Lismore, and one of them particularly was very highly flood exposed. Now, that community housing provider told us that they didn't want to rebuild the house that got flooded up to its roof in that flood event, because they didn't want to put their tenants at risk again by being in that house. So rather than repairing it, we were able to make the decision with the board that we'd settle the claim as a cash settlement, and the community housing provider already owned land that was up away from the floodplain there. So they were able to then take that and rebuild a new house in a new location, rather than us forcing the policy conditions where you know, rebuilding as is would be a more typical way to have covered that sort of claim. And that helped our ARC as well as the member, because now our ARC has removed the risk of that particular house from being within the portfolio as well. And we did identify it up front that it was a high risk flood exposure, but the member did decide to pay for that flood protection. And so they were protected for that flood loss when it did happen. Another example of where the discretion has been applied is that we had an accommodation provider, and they had a storm damage claim right before their busy season. And so they got their own provider out that day to give a quote to repair the damage. And the board was able to use their discretion to settle that claim promptly to their own provider, rather than needing to go through a quote process with multiple providers, which meant that we were able to get the property repaired within 2 weeks and have them up and running in time for the busy season where they had accommodation booking. So they were very happy with the outcome there, that the claim was settled so quickly, and again, outside of what would probably be a usual process. And maybe the third example that we have there, where the board has actually decided to settle in excess of what otherwise would have been protected within the policy, is that we had a church where there was a stained glass window, and that stained glass window was broken through vandalism. Now, the board there decided to settle it, but also to add on to that some additional plastic protection over the stained glass window, which meant that that would prevent future vandalism or hailstorms or the like from smashing that glass window again. So essentially betterment, but in doing that, we prevent other claims of a similar nature from coming through to the mutual. So again, in the long term, it is for the benefit of the members in the mutual because you're reducing the actual exposure within there. So the claims discretion can be used in lots of different ways, as long as it's for the benefit of the members within the mutual there. And that's what the board has in mind when they're making their decisions around these claim settlements.
Great stuff. And Simone, sticking with you, are brokers involved in the RRARC claims process?
Yeah, it depends on the member. So they can provide claims assistance, and that's part of one of the important services that brokers do provide to their clients. So sometimes the members will come to RRARC directly, or sometimes they will go through their broker, and then RRARC will keep the broker informed along the way with the claims process. So in either scenario, we're working with the member or working with the broker with a focus on resolving that claim in the best way for that member. But yeah, it depends on how the member and the broker want to operate as to whether they have the brokers involved or not.
Great stuff. Charlie, was there any other points you wanted to make about brokers?
There was a question in the Q&A about do brokers have to be the sort of intermediary in setting up a mutual? The short answer is no. The question says, can an association go direct to Picnic to set up or contribute to a mutual? Yes, it can be a direct thing without an intermediary, but it really depends on the nature of the association and a few other bits and pieces.
Yeah, fair enough. Okay. Here's another question. Can discretionary mutuals use premium funding solutions even though contribution isn't premium?
Yes, good question. And so the answer is mileage varies depending on the premium funder. So certainly some have a straight rule that has to be insurance, but others are more flexible. So mileage varies. We've been using AtVest for many of our ARC members, for instance. They're very comfortable with our ARC.
Good stuff. And will members be called on for capital?
Yeah, this is in the category of another one of those myths, actually. So the short answer is it really depends on what the Constitution says. Every discretionary mutual has a Constitution, and that Constitution usually describes the extent to which there can be a call and is usually a monetary limit. That's the gap part, that's the guarantee part. So for instance, our ARC mutual has a $1 guarantee. So whilst technically, yes, there could be a call, certainly the way we would manage a mutual is that we have a capital management strategy, and there's a number of different levers we have for capital in the mutual, including mutuals can issue capital instruments known as mutual capital instruments, which are essentially shares in the mutual which don't cause the mutual to be demutualized. So there's a number of different avenues you can go down and basically not have to make a call on members.
Right. Okay, if it's okay with you guys, I'll get into some of the audience questions. There's quite a few here. So we'll get through as many as we can. Are there any self-insurance funds run by a trust? If there are, what are the disadvantages?
Certainly there are self-insurance funds run by trusts, not by Picnic. But yeah, there are other organizations that run discretionary trusts. We see the real key advantages in a discretionary mutual company limited by guarantee around transparency. So transparency around the full cost base of the mutual. There's annual financial statements lodged with ASIC distributed to members. There's an annual general meeting every year, and you also have the member representatives on the board. So we see from a member perspective, that's one of the key benefits. And then there's other operational benefits that we see around we don't have to have AML and CTF type requirements that there may be for a trust and things like that.
Great. Here's one on claims. What's the typical timeline for claim approval or denial?
I would say the short answer is certainly not longer than for a normal insurance type situation. In fact, quite often quicker. And the main reason it's quicker is a function of our product wordings and things like that. So certainly the way we have been operating our mutuals, we see the claim turnaround, particularly on decisions by the board, being very quick. Generally, the acceptance or otherwise of the claim is in an initial sense within 24 hours of the notification of the claim. And we also then have obviously go and get reports and things like that. So the more detailed decisions around settlement are no different to what you would normally see in an insurance company. And, you know, as I said before, for various reasons, sometimes quicker.
Great. Are mutual members required to, or do they routinely take out any kind of XOL cover or any other second line protection?
Yeah, so Simone, I'm not sure if you want to speak to that
Yeah,
one.
I can answer this one. So the mutual itself can take out reinsurance protection. So the mutuals that Picnic manages, the board of directors operates to a reinsurance management strategy and a capital management strategy, which dictate how much reinsurance and what structures of reinsurance the mutual itself will buy. Sometimes if there's a cap on the protection within the mutual, then there may be need to get excess layers of insurance for the particular members. For example, we have one mutual, which is a financial lines mutual, where the capacity of that is limited to $10 million. And so there are insurance excess layers that sit above that are purchased in the open market insurance.
Sounds interesting. Could you please further explain the claims hurdle? Is that like an aggregate amount?
No, it's a per loss amount. So similar to what a claims excess would be, that every time there's a loss, that amount applies. It's just in this case, if the claim amount exceeds the hurdle, then 100% of the claim is paid. So say you have a hurdle of $5,000 and the claim is $6,000. The $6,000 is the actual amount that would be settled to the client, as opposed to where you have a claim excess, then it would be the $1,000 that sits in excess of that $5,000. So it's yeah, all or nothing essentially with the claims hurdle.
Okay. Here's another one. How much capacity does ARARC retain versus reinsurance? Please, can you confirm how much influence reinsurers have over large losses?
Yeah, so ARARC, as I said, it does have a capital management and a reinsurance management strategy. And so the amount that's retained varies year on year as the mutual's growing, and the board is constantly reassessing the amount of capital within that mutual and structuring the reinsurance around that. So it's not an exact figure, and it'll depend on the size of each member as well, because we have, as I said, some very small members and some very large members with large properties coming into the mutual as well. So yeah, it's structured around the needs of the mutual and ensuring that there's appropriate capital and reinsurance to continue to pay claims.
Brilliant. And what's the best way to work with Picnic to set up a new mutual?
Charlie, do you want to take that one?
Yeah, so there's certainly information on Picnic's website. That's picniclabs.io. But yes, people can reach out to us, and then we have an initial conversation. So that initial conversation usually focuses on, just at a high level, does it look like it's feasible? And then we go beyond that into a more detailed design and so forth. Process, which is usually on a sort of consulting basis, and then a decision can be made of where reach out to us in the first instance, and we'll have that initial conversation to understand what it's about and the member base and whether it's likely to be feasible.
Right. These questions keep coming, which is brilliant. And how do renewals work with mutuals?
Yeah, renewals work generally like a typical insurance renewal, where the member would be provided with renewal terms, usually around 4 to 6 weeks in advance of the renewal occurring. Probably the key difference here is that at each renewal, the mutual can assess how much surplus is retained within the mutual, so essentially how much profit they made. But because it's a not-for-profit entity and the surplus is for the benefit of the members, then at the renewal, if there is sufficient surplus, that can be factored into the renewal pricing. So essentially over time, the idea is that that renewal pricing would be able to come down year on year if the claims plus expenses were less than the contribution in the previous year. So the surplus is retained. It's not sent out as, profit, dividends, anything like that. So the members can benefit from that. And usually there would be a surplus management policy that would speak to how that actually works. So looking at how long a member has been with the mutual, the claims for the mutual, and the surplus amount. So we've just lost Charlie. Hopefully he'll join us again, but I can continue with the questions in the meantime. So yeah, like a typical insurance renewal, but factoring in that surplus.
Brilliant. And here's a topical one for you, Simone. Can you cover strata?
It is very topical. So we have had opportunities come our way in the strata space. The main complication that we have with regards to strata is that there is legislation across most states. I haven't looked at every single state, but across most states that say that strata provided or strata organizations need to have an insurance policy, and generally the definition of that is that it's an APRA regulated insurance policy. So because what we provide is risk protection, that product generally wouldn't be suitable for strata, but there are ways that we can look at it. For example, using a mutual as a aggregate deductible type structure, and then purchasing the strata insurance with a higher deductible than what would usually be needed. So essentially like a two-stop placement where you have a mutual operating for the first losses and then an insurance policy that sits over the top to protect that. So it is something that we have explored, but as I think everybody on this call is probably aware, there are some complications in the distribution space around strata. But if anyone wants to have a conversation, please reach out, because we have looked at it and we do have a few ideas in the space about how it could work.
Cool. Okay. Is there a minimum total premium that makes a structure viable?
Yeah, it depends on the level of involvement that needs to happen with the mutual. So we have some which are quite low touch, where essentially you have a fixed group of members and that group renews annually, and there's not a lot that needs to happen year on year in the meantime. So for those, it's a pretty low cost operating model. We have one of those that probably operates at about $1.5 million worth of overall premium. But then it can scale up from there. And the things that need to be covered within that cost are the fixed expenses of operating a mutual. So if there's paid board director members, then that would need to be covered. That's not always the case, but if that is. And then there's things like audit fees, directors and officers insurance, management fees for Picnic's management, and then any reinsurance or insurance that needs to be purchased as well. So there's not a hard and fast rule, but yeah, usually about that 1.5 million would be the minimum, and then it can scale up from there.
Right. Okay, as you said, we do seem to have lost Charlie. You may have had some technical problems, but I'll keep firing these questions at you, Simone, and just tell me if you want me to stop. How are the startup costs typically funded?
So usually there's a proponent for each mutual, and whether that's a person from the membership community or a broker that might have a membership base, they can come to Picnic and scope out setting up that mutual. So we do a little bit of initial work to check the feasibility, so looking at the products and the size of the potential mutual and whatnot. And then if it passes the first hurdle, then we'd provide a scope of works. That scope usually covers two stages. One is a feasibility review, so an in-depth review of looking at the entire operation of the mutual from end to end, including capital, financials, reinsurance, operations. And then if at the end of that, the business plan stacks up, then there would be a second phase, which is to actually build out the mutual. So the startup costs are usually charged in those two phases, where there's a lower cost for that feasibility review. And then when the decision is made to purchase, to go ahead and build the mutual, there's an additional fee to undertake that part. But yeah, usually that's funded by whoever's sponsoring the mutual, essentially. So yeah, broker or member of that.
Right. Now Now, there's lots of mentions of property insurance. Is financial lines protection common under mutuals?
Yeah, we do. As I mentioned earlier, we do have a financial lines mutual set up at the moment. That one is the structure that I was talking about before, where you have an aggregate deductible, essentially, that is the mutual fund, and then insurance policies that sit over the top of that. That's how we structured that one, but it's not to say that it has to be every financial lines mutual that looks that way. So we have explored other ones in professional indemnity and D&O. So yeah, I think it's basically any product can be within a mutual as long as it stacks up for that. So we've looked at marine, we've looked at public liability, we've looked at financial lines, we've looked at property. So yeah, it could be any product within the mutual, and those products are designed then for that membership base.
Right. Here's quite a lengthy one. How are members' mortgagee interests noted, and how have financiers, debt providers, become comfortable with our ARC not having an S&P rating and being essentially monoline?
Yeah, so we can note interested parties or financiers on the schedules of protection that we issue for our ARC. And we have had multiple instances where we've had to do essentially a due diligence process for those finance providers. So generally the finance providers will contact Picnic and we can deal with them directly, providing them financials, details of reinsurance, details of the products themselves to get those ticked off. So we haven't had any issues in that space, but it is something that some of the financiers might need to go through a process to get comfortable with the mutual in the first instance. Right.
And can you talk more about the licensing requirements for insurance brokers to get involved in DMFs?
Yeah, sure. So there's a license category for the AFSL called miscellaneous financial risks. That is the license that allows a broker to deal and arrange in these miscellaneous financial risk products, which are the risk protection products. So it is an extension on a typical AFSL. It's not something that everybody has. If you don't have that license, then there are still ways to work with our ARC, essentially in a referrer capacity. So our ARC sets up referrer arrangements where you can bring the customer to our ARC, but then we'll be dealing directly with the customer in issuing their documents because, you know, making sure that there's no breach of any licensing there. So we can work with all brokers, but the way that we work with them would just depend on what license they actually have, whether they have that miscellaneous financial risks extension or not.
Brilliant. Okay, we'll try and squeeze in a few more. How does a discretionary mutual determine operational costs, e.g. salaries? Is this determined by the board or by members?
So as I mentioned before, there are some fixed operating costs, which are things like audit costs, D&O, board costs potentially, and management fees to Picnic. So usually it's the board of directors that sets the costs. So for example, the mutuals that we manage have a mutual management agreement that's signed by the board of directors for that mutual, and within that mutual management agreement it sets out all of Picnic's operating fees that we take for managing that mutual, and that can vary by, you know, how much work Picnic actually needs to do for each of the mutuals. But some of those other ones are whatever we can source from, you know, the market, like audit. We don't really have much control over how much the audit costs. Of course, there's procurement processes to get multiple quotes and make sure that all of those fees are within reason. But yeah, it's mostly the board of directors that's approving expenses, noting that the board of directors is at all times acting in the best interest of members when they're doing that.
Brilliant. And this sounds like a tricky one. What happens if the mutual contribution pool exhausts and there are claims to be paid for any given year?
Yeah, so the mutuals, as I said before, act to a capital management strategy, and that capital management strategy sets out actions that the board can take if the mutual's capital is below its operating target, hopefully not exhausted, but in that case as well. So That can include things like looking to raise additional capital, and that can either be from the membership base or from third-party capital investors. These mutuals are able to accept third-party capital in what's called a mutual capital instrument. So they pay dividends. It can be an investment opportunity there. There's also options to not pay 100 cents in the dollar on claims that are outstanding, or to essentially look at like reinsurance as well as the potential additional capital stop. So the board of directors will look at that capital management strategy and decide within that what's the best way forward for the interests of all of the members in sourcing that capital.
Right. Here's another one. Are DMFs suitable for low frequency, high severity cat perils?
It can depend on the structure and having the right reinsurance backing, essentially, because like an insurance company, the cost of capital is a factor within this. And so usually the capital is paying a return or is which like opportunity cost from whoever's contributed that capital. So if the mutual is able to source appropriate reinsurance arrangements to support the low frequency, high exposure claims, then yes, absolutely, it can go into a mutual. Yeah, so it's really dependent on that capital and the reinsurance piece.
And can a member leave a mutual, and do they get a refund of their contribution?
They can leave. They get, depending on each mutual, but generally a pro rata refund of the unearned portion of that contribution. They don't get a refund of any surplus that they've contributed over the year. So example, if they've been in the mutual for 3 years and they decide to leave and they haven't had any claims, they don't get their past year's contributions refunded. It's only the unearned portion.
Right. And how do you define a community? Is this a group of people who are exposed to the same risk and therefore require the same product solution?
Yeah, it can be quite broad, or it can be quite tight. So we have communities where, for example, there's a management group that manages a bunch of properties. And so every property that's managed by that management group is within the community, but they can have different protection needs within that. The ARARC one that I talked about earlier is quite a broad definition of community because that's the way that the Anglican Diocese of North Queensland wanted it set up. So it's essentially community for them means anyone who's wanting an alternate to the insurance market and their organisation is there to serve a local community. So yeah, like whether that's community housing or not-for-profits or faith or education, that can all be within the community, and the community there is the ones who are within the mutual, or it can be a lot tighter definitions of specifically, you know, the association members of a particular association. So that's part of the assessment that we do when we're looking at setting up a mutual is, well, what is this community, and is it a closed community or is it going to be an open community where broader membership base can join it?
Brilliant. Now I have just heard that Charlie is fine. He was not the victim of a cyber attack. His internet went down. These things happen. One last question, Simone. How do reinsurers and discretionary mutuals address the flexibility on claims payments in the mutual? How do reinsurers get a level of comfort and model losses when there is no fixed contract for payment of claims on the primary layer?
Yeah, so the mutuals do issue a product disclosure statement, PDS, that outlines the inclusions and exclusions for the protection. So that is what's used as the basis of the reinsurance as well. If there's a claim settlement outside of the T's and C's in the PDS, then that would be a discussion with the reinsurers like it would be for any ex gratia claim that's typical in insurance. So that's how we've had the reinsurers get comfortable with the fact that it is a discretionary product, yes, but there is still a PDS that outlines exactly what is included and excluded within there, and being able to have that discussion if the board does want to settle a claim outside of those T's and C's, and the board wouldn't decide to settle that claim until they've had that discussion with the reinsurance, because it's not in the benefit generally of the mutual to settle a claim outside of the PDS if there's no reinsurance support on it.
Brilliant stuff. Now, unfortunately, we're out of time, but thank you very much, Simone, for your sterling efforts there. And thanks to Charlie as well. And sorry we lost you. Thanks to everyone who tuned in. I'm sure you picked up a lot of really interesting insights there. And we hope to see you again in future. In terms of the questions, we weren't able to get through everything, but we do have a record of all those questions. So we can try and address those in future. Now, obviously, you can look up Picnic online and get in touch with them that way as well. But thanks, Simone, and thanks to everyone for tuning in.
Thanks, John. Thanks, everyone.